Stock market crash coming. How to prepare and protect your investments. The stock market, a dynamic and sometimes unpredictable environment, can be a source of great wealth. However, it is also susceptible to crashes. And with frequent talk of economic instability, many investors wonder if a market crash is looming. While no one can predict a crash with certainty, it's essential to prepare and protect your investments to weather any potential downturn. Signs that a stock market crash could be coming. Rising inflation. High inflation erodes purchasing power and can lead to aggressive interest rate hikes by central banks, which can in turn depress market performance. Increasing interest rates. As borrowing becomes more expensive, both businesses and consumers tend to spend less, which can negatively impact company earnings and stock prices. Geopolitical tensions, conflicts, trade wars, and political instability can trigger global market declines due to uncertainty. Overvaluation of stocks. If stock prices become excessively high compared to the underlying fundamentals of the companies, it can lead to a correction or crash. Economic indicators. A weakening economy, rising unemployment, or negative GDP growth may suggest an impending downturn. Steps to protect your investments. Diversify your portfolio. One of the most effective ways to protect against a market crash is diversification. Don't concentrate all your investments in one sector or asset class. Include a mix of stocks, bonds, real estate, and possibly alternative investments like commodities or cryptocurrencies. This helps reduce the risk, as not all assets react the same way during a crash. Invest in defensive stocks. Defensive stocks are from sectors that typically perform well even in economic downturns, such as healthcare, utilities, and consumer staples. These industries provide essential products and services, meaning demand remains relatively stable even when the economy is struggling. Maintain an emergency fund. A solid emergency fund provides liquidity in times of need without requiring you to sell off investments during a downturn. Having cash on hand allows you to weather personal financial hardships or take advantage of market opportunities when prices are low. Consider dollar cost averaging instead of trying to time the market. Dollar cost averaging allows you to invest a fixed amount of money regularly, regardless of stock prices. This strategy helps you avoid the emotional highs and lows of market fluctuations and ensures that you're buying more shares when prices are low and fewer when prices are high. Rebalance your portfolio. Regularly review and rebalance your portfolio to ensure that your asset allocation aligns with your risk tolerance and investment goals. If your stocks have surged, you may want to sell some and move the funds into safer assets like bonds or cash equivalents. Build up cash reserves. Keeping some cash in your portfolio gives you the flexibility to buy quality assets at a discount when the market falls. Cash is also the safest investment in a downturn, since it's immune to the price fluctuations of stocks. Focus on long-term investments. Market crashes are often short-lived compared to the overall growth of the stock market. Historically, markets recover and reach new highs. If you're investing for the long term, focus on your overall strategy rather than the temporary swings. What to avoid? Panic selling. One of the worst things you can do during a market crash is panic selling. Selling off investments during a downturn locks in your losses and prevents you from benefiting when the market recovers. Chasing high volatility assets. High risk investments like speculative stocks or volatile cryptocurrencies can see massive swings in value during a crash. If your goal is to protect wealth, consider lowering exposure to these kinds of assets. Ignoring financial news. Staying informed about market trends, economic policies, and geopolitical events can help you make better decisions. However, avoid letting headlines drive emotional reactions to short-term market noise. Conclusion: a stock market crash can be unnerving, but with proper preparation, you can protect your investments and even take advantage of lower prices to buy solid assets at a discount. Diversifying your portfolio, focusing on defensive stocks, and maintaining a long-term view are key strategies to help you navigate turbulent times. Remember, market downturns are part of the economic cycle, and history shows that markets tend to recover over time. Preparation and patience are your best defenses.